It's March 2020. The world has just been told to go home. Restaurants are shuttered. Airlines are grounded. 30 million Americans file for unemployment in the span of 6 weeks, the fastest economic collapse in recorded history. Doctors are rationing ventilators. Hospitals are overwhelmed. People are dying alone in rooms with fogged-up glass windows while their families wait outside in parking lots. And the stock market? It crashes for exactly 33 days. Then it starts going up. By August, 4 months into the worst public health crisis in a century, with unemployment still near 14% and no vaccine in sight, the Nasdaq hits an all-time high. Let that sit for a second. Not a recovery, not a stabilization, an all-time high. Millions of people had lost their jobs, their savings, their businesses. Some had lost family members. And somewhere in Lower Manhattan, a number on a screen was doing better than it had ever done in its entire history. That is not a coincidence. That is not a quirk. And it is definitely not evidence that markets are irrational or stupid. It is evidence of something far more deliberate, far more structural. And once you see it, you cannot unsee it. This is the real reason stock markets rise while people struggle, and it has been hiding in plain sight for decades. Let's start with the question most people don't actually ask. When you hear the stock market went up today, what do you think that means? Most people, somewhere in the back of their heads, hear a rough translation that sounds like things are going well. The economy is healthy, companies are growing, life is improving. That's the story we've been sold. Markets as a thermometer for human prosperity, a rising tide, a shared scoreboard. And for a stretch of the 20th century, that story had some truth to it. Not the whole truth, but enough. After World War II, wages and productivity basically moved together. When American companies got more efficient, workers got paid more. When the stock market rose, there was at least a loose correlation with broader economic health. You could look at the Dow Jones and get a rough sense of how things were going. That relationship started breaking down in the 1970s. By the 1980s, it was fracturing. By the 2000s, it was gone. And now, in the mid-2020s, the two things, stock market performance and median American economic experience, have become so disconnected that economists have given the gap a name. They call it the Main Street versus Wall Street divide, which is a very polite way of saying the thermometer no longer measures your temperature. So, what does it measure? Here's where we need to slow down and build something together, because to understand why stock markets rise while people struggle, you need to understand 3 things that most financial news completely ignores. The first thing is who actually owns stocks. Not who can own stocks. Anyone with a phone and a brokerage account technically can. But who actually does in meaningful amounts. The numbers here are staggering. As of 2023, the wealthiest 10% of Americans own approximately 93% of all stocks. The top 1% alone owns more than half. Read that again. When the S&P 500 goes up by 10% in a year and the headlines celebrate the gains, roughly half of those gains flow to people in the top 1% of wealth. The bottom 50% of Americans, about 160 million people, own somewhere around 1% of all stocks combined. So when the market goes up, it is not going up for everyone. It is going up for a very specific group of people. People who were already wealthy. People whose day-to-day expenses represent a tiny fraction of their net worth, which means market gains don't just enrich them in theory. Those gains compound, get reinvested, buy more assets, and widen the gap further. The stock market is not a shared experience. It's a club, and the cover charge is a level of wealth most people never reach. That's the first thing. The second thing is what stocks actually represent and what they don't.
Here's the part that surprises people. A company's stock price is not a report card on how well that company treats its workers, how much it pays in wages, or whether it's creating jobs. It is a number that reflects what investors believe the company's future profits will look like. Future profits. That's it. That's the whole game. And here is where it gets uncomfortably logical. Because if future profits are what drive stock prices, then anything that increases future profits, even at the expense of workers, is, from a purely mechanical standpoint, good for the stock price. Layoffs? Good for the stock price. Moving manufacturing overseas to pay workers $3 a day instead of $30? Good for the stock price. Replacing full-time employees with contractors who don't get benefits? Good for the stock price. Automating jobs out of existence? Good for the stock price. Every one of those things is catastrophic for the people it happens to. And every one of those things, in the cold logic of financial markets, is typically celebrated by investors. In fact, there's a pattern so reliable it has become a dark joke in finance circles. A major company announces it's laying off 10,000 people. The stock goes up 3% the next morning. Analysts issue notes saying the company is getting leaner. The CEO gets a bonus. It's not evil in a cartoon villain sense. It's just a system following its own incentives. The problem is that those incentives have almost nothing to do with human well-being. That's the second thing. The third thing is the one that ties it all together, and the one that explains March 2020 better than anything else. The third thing is the Federal Reserve. Most people have a vague sense that the Federal Reserve exists. It's a central bank. It sets interest rates. It does something important. What most people don't fully grasp is the degree to which the modern stock market has become, in a very direct sense, a creation of Federal Reserve policy. Let me explain how this works without making your eyes glaze over. When the Federal Reserve wants to stimulate the economy, it lowers interest rates. Lower rates make it cheaper to borrow money. Cheaper borrowing theoretically encourages businesses to invest and consumers to spend. That's the textbook version. Here's what actually happens. When interest rates are near zero, which they were for most of the period between 2008 and 2022, something strange occurs. Investors no longer make meaningful money by parking cash in safe places. Savings accounts pay nothing. Government bonds pay almost nothing. So where does the money go? Into stocks, into real estate, into assets. Not because those assets are fundamentally worth more, but because they're the only game in town. When there's nowhere else to put money and still earn a return, money floods into equities. And when money floods into equities, prices go up. Not because companies got better, not because the economy improved, but because cheap money had nowhere else to go. This is called reaching for yield, and it created one of the longest bull markets in history. Now add the second part of the Fed's toolkit, something called quantitative easing, or QE. This sounds complicated. It's not. Quantitative easing is when the Federal Reserve creates new money and uses it to buy financial assets, primarily government bonds, but also mortgage-backed securities and other instruments. It did this on a massive scale after 2008, and it did it again even more massively in 2020. When COVID hit and markets crashed in March, the Fed didn't wait. Within weeks, it had announced it would buy essentially unlimited quantities of assets. It cut rates to zero. It injected trillions of dollars into financial markets. And the market, which had been pricing in economic catastrophe, suddenly realized something. The Fed was not going to let it fail. So it stopped going down, and then it started going up. The economy was still in ruins, unemployment was still at historic highs, small businesses were still dying, but the financial system had been flooded with cheap money, guaranteed by the central bank, and that money had to go somewhere. It went into stocks. This is the moment people need to sit with because it is genuinely clarifying. The stock market didn't rise in 2020 because the economy was recovering. It rose because the Federal Reserve made it rise. It rose because trillions of dollars were injected into financial markets, while Main Street waited for stimulus checks that for many Americans totaled less than $1,000. That is the uncomfortable math. While regular people were waiting for $1,200, the Fed was pumping $6 trillion into financial markets in a matter of months. $6 trillion. To put that in perspective, $6 trillion divided equally among every adult American would be more than $23,000 per person. That money did not go to people. It went to markets, to bond prices, to asset valuations, to portfolios owned predominantly by the already wealthy. And the market hit all-time highs. Now, zoom out, because this is not just a COVID story. The pattern, market rises,